Hello and welcome to Cafe Mutual YouTube channel. Friends, hybrid funds have been gaining strong traction among investors lately. In fact, the category has witnessed around 26% growth in the calendar year 2025. And during volatile market phases or uncertain global situations like war, many experts often recommend hybrid funds. So today we'll dive deeper into why hybrid funds are attracting so much attention and how MFDs can use them efficiently in their portfolios. To discuss this, we are joined by Mr. Rajesh Jayaraman, Head Product Management at Nippon India Mutual Fund. He brings over 2 decades of experience across asset management and banking industry. So, without wasting time, welcome to the show, Rajesh, first of all.
Thanks, Nishan. Thank you.
So, Rajesh, my first question is on everyone's mind. So I wanted to understand that what is your medium-term outlook on equity, debt, and commodity markets?
Sure. So I think what is more topical today is the ongoing geopolitical conflict starting in the Middle East primarily. And obviously, there are a few other geographies where there has been some kind of a geopolitical tension which is there. So that is taking the headlines. And naturally, near term, see, none of us are experts when it comes to predicting some of this global macro geopolitical kind of events or shifts. Uh, so it is the only thing simple understanding today is if the escalation happens over a long period of time, obviously it's going to have a detrimental impact, both in terms of growth and in terms of the investor sentiment. If this ends quickly, there is some kind of resolution, things may not be so bad. But the fact is, there are times when headlines is what grabs all of our attention, and we tend to miss the wood for the trees. So that's typically one more case in point, even with markets, and when we look at market outlooks, correct? So, had this event not happened, what are the few things which would have been the talking points today? Just look at the last few months. What we have seen is the quarterly earnings numbers, the Q3 numbers actually started to improve after 8, 9 quarters of very, very subdued kind of earnings. Things started to look up. Obviously, poor base effect, everything notwithstanding, things started to look up. Some of the measures which was unveiled in 2025 by the government, starting with the interest rate cuts, followed by income tax rationalization, along with that GST 2.0. All this in some way have contributed to the demand recovery in the post-festive season of last few months, which was starting to show some kind of green shoots. At the same time, from a global standpoint, the biggest talking point for 2025 was the tariffs and its impact. And what we had witnessed was India entering into a very, very important trade deal with the European Union, a free trade agreement FTA, and also preparing a framework for a deal with the US, which obviously could not be executed given all this current geopolitical kind of hangover which is there. So all this was the talking points, and at the micro level, typically when you look at the Indian economy, how things are shaping up, they were showing signs of improvement. And suddenly this global event happened, and obviously most of the talking points went towards that. So much so that it's overshadowing whatever positives has been there from an economic standpoint. So we believe some of this would play out from a medium-term perspective. We have seen many a dime a dozen kind of global events starting from 2008, the global financial crisis, to the recent Russia-Ukraine war, and in between we had the pandemic, and then before that we had a lot of currency crisis. All this keeps happening because the global world is such that you will have this kind of events happening. So if this doesn't escalate to a very large level and doesn't really stay for a longer period of time, some of the underlying strength of the micro or the domestic economy will be to the fore. And that is what I think investors should look at. So, what are some of the things which investors can consider in today's scenario? Broadly, the equity outlook remains optimistic. If you look at from a valuation perspective, in fact, the last 2 years, one of the challenges for the Indian equity markets, in fact, two challenges was prominent. One was in terms of valuations being fairly elevated or high, and
Hmm.
second was the corporate earnings starting to become or the growth in corporate earnings started to become much slower. So these two challenges, at the margin, we could see corporate earnings started to slightly turn around, given the poor base effect and some of the measures which we mentioned earlier. And from a valuations front, today, when we're looking at large caps today are trading less than 19 times on a 1 year forward basis, which actually puts us in a relatively well placed from a valuation perspective. Also, when you look at India's valuation today vis-a-vis the emerging market space, because that's a pool which India competes for allocations, India's premiums has come off significantly from a high of 80 at some point of time in the last few years. Today, our premiums levels have dropped to below 30.
Mm,
In the last couple of years, India has underperformed
mm,
the emerging market space. So naturally, we see that valuations have started to look better, while there could be some relative uncertainty from a near-term perspective. On the medium term, some of these factors should start to work. So hence the outlook on equities remains optimistic. The only caveat is please look at this asset class from a slightly longer term time frame, a 3 year, a 5 year kind of time frame.
okay. So, Rajesh, can you share some highlights of Nippon India hybrid strategy since we are talking about hybrid funds?
Sure, sure. So hybrid funds, Nishant, as you rightly mentioned at the start,
Mm,
have gained a lot of prominence, and a lot of investors today are looking at hybrid products. And one of the reasons has been this huge shifts in
mm,
terms of the global policymakers, be it the trade deals or the geopolitical tensions which has been happening, which means a lot of things can change very, very quickly. In fact,
mm,
the recent data point which says that oil prices moved up by almost 50% in less than, or almost by 100% rather, in less than 7 days. So it tells you the some of these things are very, very unforeseen, very difficult to predict. So that's where hybrid as a category fits in beautifully from an investor's portfolio, because there's an inbuilt element of risk management. Again, there are many funds in hybrid. Depending upon the which fund within hybrid you're looking at, each of them bring with its own sets of risk management kind of philosophy, and that is where probably some of the situation, the experience which an investor gets could be much better. And that's the reason why probably so many investors today are looking out for hybrid funds. So even at Nippon India Mutual Fund, we believe hybrids are a very, very important category,
mm,
and it can cater to needs of a lot of investors. And which is why we have a large bouquet of offerings here. We have different 6 different products offerings which fit into the hybrid space. It starts with something as basic as an arbitrage strategy, which is highly low risk kind of thing, very, very conservative kind of product. Returns could be range bound, but it brings in with that ability to manage volatility or reduce the volatility to a good extent. At the same time, it can also offer you some tax efficient kind of return possibilities for investors. And then as you go up the curve, you have the products like a conservative hybrid, which is primarily debt oriented with some equity allocations thrown in. And then there is a dynamic asset allocation category, which is there where the equity allocation is managed dynamically and the rest going into fixed income. And then there are the multi-asset kind of varieties where you have multiple asset classes within part of the same offering. So Nippon India Multi-Asset Allocation Fund, for instance, invests into domestic equities, international equities. It's also invests into commodities, primarily gold and silver. And it can also buy into the exchange traded derivatives for the commodities, ETCDs, wherein you can participate in a basket, which can be even involving crude and stuff like that, and some portion into debt. So it has 4 different asset categories there. Then there is aggressive hybrid fund, which we offer, which is typically the old school balance kind of fund where 65 to 75% is equity at any point of time, and rest goes into fixed income. And then there are some fund of fund varieties also, which is again a multi-asset allocation fund of fund which we have, which is called Omni, because it can invest into active as well as passive strategies, which also invest into equity, debt, and do
mm.
commodities or precious metals. So within the basket itself, you will see all different kinds of hybrid products. So somebody is very conservative, parking for a very short term. For them, there's high arbitrage kind of product. Somebody who's seeking better than fixed income kind of returns. For them, a balance advantage kind of fund product fits in. Somebody who says, no, no, I want to even get a product which can give me some exposure to commodities, a multi-asset kind of product fits in. So you can see how this entire gamut is covered at Nippon India Mutual Fund.
Got it, got it. So, Rajesh, gold and silver have had a dream run this financial year. So, do you think continued exposure to gold and silver still makes sense, or investors should stay away from commodities for some time?
Sure. Very, very important question. I think, Nishan, this has been one question which is been asked by a lot of investors, because, as you rightly mentioned, they have seen the phenomenal returns of both this category, silver in the recent past, and gold over the last few years has been dominating so much. So I think over the last 10 years, probably gold has been the best performing asset class for almost 50% of times. So it tells you that these asset classes have done fairly well. But if you look at the fundamental reason, they are very, very different for both of these asset classes. Gold is often perceived as a safe haven, especially if you're looking to hedge yourself against the volatility in the global markets, especially the US.
Mm,
Gold comes in as a very, very important diversifier from that aspect, especially in times when you believe that dollars power would be challenged or US dollar would start to weaken. That's when a lot of central bank, a lot of large investors flock to gold as a support measure.
mm,
And hence it has got its own set of investor preferences in times when things are fairly uncertain. Silver, on the other hand, is more of one commodity where a good part of it, almost it's estimated around two-thirds of silver which is produced, used consumed for industrial purposes across different areas like EVs, solars, and everything. So it's a largely an industrial commodity, and obviously some bit of investor investment element also thrown in there. That's how that commodity works. Also, what is unique to silver is the supply. There are a lot of supply constraints when it comes to silver.
mm,
So the pricing of silver also gets influenced by the demand supply dynamics also. So all
mm,
that are different factors. But to put it very simply, are these two asset classes, should these asset classes be part of an investor's portfolio? The answer is yes. But we need to be aware of the characteristics of both of them. Silver, since that commodity is not easily available and a good part of it goes into industrial space, there are times when it can exhibit huge volatility. In fact, over a longer run period of time, you would have seen silver seeing huge volatility, both upsides as well as downside. So
mm,
silver investing needs to be one who's participating in silver needs to be fairly careful because we can see very short time frame when the market the swings can be very very large. So our own sense is to keep it very simple for most investors, they can consider anywhere between 15 to 20% allocation overall of their portfolio into some of these precious metals, within which there is a bigger comfort for gold because gold comes in as more of a hedge against the uncertainty, and which is what you're trying to do. So therein, we would recommend that most investors who have a slightly moderate kind of risk profile should look at two-thirds or little about
mm,
two-thirds of money going into gold and the remaining one-third. So it could be 70-30 for simpler parlance, which can be allocated between gold and silver. But be aware of that these products also carry with
mm.
them their own sets of volatility. So it's not that they are not volatile; they can be volatile depending upon the market swings.
Okay. So Rajesh, a few fund category of Nippon India mutual fund like Nippon India Aggressive Hybrid Funds, Nippon India Balanced Advantage Fund, Nippon India Conservative Hybrid Fund, and Nippon India Multi-Asset Allocation Fund. So they all have
Right.
outperformed their benchmark over a 3-year basis. So what are
Right.
three key factors that have contributed to this spectacular performance?
Sure. So, all these funds, as I said, come with a specific mandate of how much equity, debt, or other commodities, if available,
Mm,
what kind of allocation range would they maintain,
mm,
and what are the scenarios basis which the changes in the allocation will keep happening. So, what we have done here is one important thing which we followed across our funds, be it equity, debt, also, but primarily when it comes to hybrid, and it's a big contributor to hybrid, is the investment discipline. The idea is to be very very clear and objective because you're looking at offering a product where you can do better risk management for your investors, correct? So therein you have to be very objective. You could have a fundamental view on a particular asset class today, but when it comes to the fund management, it is purely managed on the underlying investment strategy, and there is a very disciplined kind of approach there. So if something needs to be rebalanced in a particular time, even if the view is very positive for that asset class, we are very clear that it will be the discipline will take precedence over everything else. So one of the first parameters here as a contributor, Nishant, would be the investment discipline, investment rigor, which comes in. The
mm,
second important parameter, which goes similar to the first parameter, is the risk management aspect. So there's a lot of focus on that front, and there is no compromise. So risk management doesn't only mean maintaining the investment discipline,
mm,
but even in the underlying investment asset classes. For example, if you have equity allocations, fixed income allocations, or commodities, as the case may be, commodities are largely passive, but at least in case of the active elements of equity and fixed income, the attempt here is to maintain a very very high quality portfolio.
mm,
So in equities, typically, if you look at most of these hybrid products would go for at least two-thirds of allocations in large caps, and even the rest would be in the larger companies, in the larger mid caps kind of names, or some of the large small caps. So that would be the allocation, so that the quality is not compromised. This is one. Secondly, in terms of fixed income, again, it's primarily a AAA oriented kind of product with no big duration or credit calls. So there is a lot of investment discipline. So the duration range is we internally we don't go beyond 4 years of duration there. Similarly, AAA, largely AAA kind of focus from asset category point of view. All that has contributed to this. So I think it's more of the dynamic or the regular rebalancing as the investment strategy allows, and maintaining very, very high quality portfolio. So these two things are our biggest contributors when you look at the hybrid fund performance.
Got it, got it. Great. Rajesh, I have observed that in all equity-focused hybrid funds, there is very high exposure to bank, auto, and IT sectors. So, what's the rationale behind this?
Sure, sure. So one thing, Nishan, just to follow on the previous point. So typically, when I said most of these products are large cap oriented, one more element here is that we try to ensure that some of the bigger themes or sectors of the index get a rightful representation in each of these portfolios. Or in simple words, the deviation
Hmm.
from the large two, three sectors of the index is relatively kept low in
Hmm.
this product, because the idea is to participate in some of these asset classes, but don't give that extra risk to the investors. So,
Hmm.
if that being the case, if you typically look at most indices, you will see
Hmm.
financials, which includes banks, as being one of the highest weighted sectors of the index. The second biggest sector in most cases, in most indices, would be IT.
Hmm.
So, so, so because of these two sectors being fairly prominent in the index, there is some representation. Obviously, you could be still underweight in some of these sectors, some of these themes. Financials obviously is a much bigger theme, within which banks is only a small subset. So what has happened is over the last 12 to 18 months, and even when we look at for the next 12 to 24 months, within financials, banks appears to be much better place compared to the other financial place which is there. So which naturally explains why the weights towards IT, also towards banks, is higher. Similarly, IT has gone through its own set of challenges, but within which, and obviously there's been a lot of price correction which has also happened, and it gives an opportunity. But at the same time, if you look at the underlying portfolios, it's typically the large cap kind of names, the blue chips kind of names, which is part of the IT into some of these portfolios. Autos have seen a phenomenal run in the last few months, especially after the GST announcements, which came in. The four-wheeler segment at least had benefited reasonably with much better demand coming in. So it was very tactical, you could say, or it was more contextual in that sense that you had to have some weights there to participate in that opportunity which had come. So this explains why probably some of these portfolios have a higher tilt towards these three themes.
Great, great. So, Rajesh, one last question. Why should mutual fund distributors consider hybrid funds offered by Nippon India Mutual Fund?
Sure, sure. So hybrid funds by itself is becoming very acceptable today for a lot of investors. So we have seen that as investors and the industry has been maturing over the last decade and more, investors today understand the element of risk, which also comes in with investing, and that's where hybrid as a space can fulfill that need of trying to participate in the markets, especially equity markets. At the same time, try to give you some kind of downside cushion. In fact, if you look at the data points which is available today, maybe not too long a history, but whatever little over the last few years, especially post categorization, the data points which is available, what it tells you is some of this hybrid variety of products, they have shown reasonable ability to participate around 80-90% of the capture the 80-90% of the market upsides or the equity upsides, with a reasonable downside protection, almost a 40-50% or a 50-60% kind of cushion to the downsides which has happened in the relatively shorter time frame, but they have whatever has happened in this particular period. So that is where, from an experience point of view, the investors potentially see this as an area where they would like to participate. So within this framework, if you look at the funds offered from Nippon India Mutual Fund, as I mentioned to you, we have a product to cater to every need of the investor within the hybrid space. So be it a few days to a few short term to medium term or long term, as the case may be, you have products. Some of the products can be kept on for perpetuity. For example, a multi-asset product would be relevant at any point of time, or a balance advantage fund or a dynamic asset allocation kind of category would be fairly relevant depending upon the investor's risk appetite and what goals they have or expectations they have from their underlying investment. So typically, if you look at, so one is the large varied product bouquet which we bring to the table. Second is the fact that here is an AMC which has been there for 3 decades and more, and has showcased its capabilities both on equity and fixed income side. And finally, most of the hybrid products are nothing but a blend of this. So we bring in with that proven experience, proven expertise also to the partners and to their clients through them. Third important point is typically even from a partner's point of view, because finally all of us get rewarded on the assets which we manage, correct? Hybrids as a product category and Nippon India hybrids within that space also give you an opportunity where some of the asset classes like equity can be susceptible to huge swings in the market. So in times when market sees very, very large correction,
Mm.
the AUM, which is purely a mark-to-market erosion, can also be significant. With
Mm.
hybrids, you can at least protect some of those downsides. And hence, it can offer a good via media to bring in stability of assets from a partner's business point of view also. So all these factors is what a partner can look at when they look at Nippon India offerings of on the hybrid side.
So, all right, we have come to an end to this interesting session. Thank you so much, Rajesh, for your valuable time and inputs.
Thanks, Nishan. Pleasure speaking to you as always. Thank you.
And finally, I thank each one of you, friends, for being such a wonderful audience. Have a great day at work, guys. Thank you.